I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Tom Neylan, a senior policy analyst at FATF, the Financial Action Task Force in Paris. The 40 regularly updated FATF recommendations on combating money laundering and the financing of terrorism have set the international standards in KYC, AML, CFT, and sanctions screening ever since the first set was published way back in 1990 as part of a global campaign against the laundering of money from narcotics. Now, technology has changed a great deal in the last 30 years, changing the way in which financial crime can be committed, and of course, changing the ways in which it can be combated. FATF is responding accordingly, and the purpose of our conversation today is to find out exactly how. Hello, Tom.
Hello, pleased to be here.
Now, as I just said, knowing your customer checks for anti-money laundering and combating the financing of terrorism go back a long way. Up to this point, they've had a pretty high manual content with employees at banks and asset managers and fund administrators and so on, checking and verifying physical documents. So the costs are relatively high. Is technology, in your opinion, starting to have an impact on that process?
Yeah, I think there's no question that it is. Everybody's very excited about the big flash technologies, artificial intelligence, machine learning, big data analytics, which are just starting to be developed and deployed. But what we've seen over the last 10 or 15 years is a quite steady, slow introduction of maybe less exciting, but just as useful technologies. Link analysis, transaction monitoring technology, name recognition technology, fuzzier forms of sanctions screening. And all of those are in daily use and already making a big difference to enhance productivity and increase the standardization of compliance investigations. But one key issue with all of them is where to put the technology benefit. Are we going to do the same thing cheaper, or are we going to do it better? And where the focus is now is using the really newer technologies as a force multiplier for the human intelligences that are doing compliance investigations, so that we can do better overall and be more effective at identifying money laundering rather than just doing the same thing cheaper. Nevertheless, there's the other problem, which is garbage in, garbage out, as the computer scientists say. In order to make use of these technologies, we've got to supply them with good information.
Can we have cheaper and better?
I hope so. There may be room for both.
Now, one new development which digital technology has created is, of course, these cryptocurrencies. It's created a new medium for financial criminals to launder money effectively. We're now starting to see, of course, tokenized assets, the digital equivalent of securities. Now, what impact has that had on the work FATF is doing on digitalization of AML and CFT, or is it just an entirely separate issue?
It's had an enormous impact, but it's had it in several different ways. The most obvious, a lot of your viewers will have seen 17 months ago, we published new standards on virtual assets and virtual asset service providers. So the crypto industry has been brought within the scope of anti-money laundering regulations, and we're still following up to make sure those rules are being applied effectively on a global basis. So these new technologies, crypto assets, created a new risk, a new route for money laundering, and we've had to address that. But they've also spurred another strand of work, which is the G20, the Committee on Payments and Markets Infrastructure, and the Financial Stability Board, who have been working on improving cross-border payments. And it's a major initiative that was endorsed a couple of months ago, largely in response to the fact that crypto assets, stable coins, and a whole host of other new payment technologies were responding to perhaps weaknesses in the global payments system, and that as well as responding to those new things, we need to make payments faster, better, more accessible, and cheaper. But yeah, crypto is driving a wider digital evolution at the FATF. So we're not just limited to looking at how we can manage the risks of virtual assets. We've got a much bigger work program looking at how we can use new technologies, blockchain and analytics, particularly among the supervisory and the justice authorities.
What about old-fashioned securities? Obviously, your focus initially was on payments, cash payments, because money, cash is the stuff that tends to get laundered. Do you now see the securities markets being used by financial criminals as an alternative to cash, which is getting more difficult for them?
To some extent. I mean, there are cases of every type of sophisticated money laundering technique that you can imagine, and some that you can't. But securities, it's now quite a well-regulated and thoroughly scrutinized sector. So securities-based money launderings are an ever-present threat, but it's one that the authorities understand relatively well. What's been interesting is that as authorities started responding to crypto assets, there was a period, and there still is in some countries, where it's not clear which regulatory regime they fall under. So is a Bitcoin treated like cash, or is it treated like a transferable security? And in some cases, there have been multiple different law enforcement agencies or regulators looking at the same space. That's been bad for the criminals trying to use them because it's more scrutiny, but it's also been challenging for the companies dealing in them because they've had multiple regulations to comply with at the same time.
Now, you mentioned a minute ago the paper you brought out on virtual assets. My eye was caught by a paper you published earlier this year on digital IDs. Can you tell us a little bit about how FATF sees digital IDs being applied, particularly to FATF recommendation 10? That's the one that obliges people to do customary due diligence. Do you see digital IDs playing a big part in compliance with recommendation 10?
Increasingly, yes. I mean, the core of recommendation 10 is that banks have got to conduct customer due diligence. They've got to identify and verify the identity of their customers using reliable independent sources. And the digital identity guidance provides a framework for assessing whether a particular form of digital ID is trustworthy enough to be considered a reliable and independent source. So it's now thoroughly integrated into the customer due diligence process. What we ask is for banks and others who are doing this to use a risk-based approach to determine if it's something that's trustworthy enough for them. They've got to consider how reliable is the technology, and they've got to consider the other risks around the customer or the transaction or the product. So it's not completely simple that digital IDs can always be accepted. There are different degrees of reliability within different digital ID systems. A digital ID with a lower level of reliability might be appropriate for a low-risk product, something with a low transaction limit or without international transaction permits. On the other hand, you want a much more reliable digital ID for a full-service account or for a high-risk product.
As you say, you're advocating a risk-based approach, as in a way you always do. But one of the things I think which would help digital IDs really take off is if users of them could be confident that they were meeting some kind of minimum international standard in terms of that risk assessment process. Do you feel that the standardization of what the paper calls, assurance frameworks and technical standards, do you feel that standardization process is progressing in the right direction? Is it progressing well?
Yes and no. We're the first body to produce guidance on digital ID internationally, which was surprising when we started working on this. And a big challenge for us was mapping all of the different international standards in this area. The guidance asks governments to work together on standardization and on interoperability, but it's not our role to deliver standardization in ID. We'll leave that to others. So there are significant efforts to cross-compare and standardize the frameworks out there. There are digital ID interest groups such as Open Identity Exchange that are working on mapping the different assurance levels under the standards in the US, Europe, Canada, Australia, and others. And one of the most interesting recent developments is the G20, which has committed to working with others under the cross-border payments roadmap, which has this as one of the key deliverables. So we're working alongside them, and we're hoping that's going to accelerate progress quite rapidly.
Mm-hmm. I'd like to ask you a slightly unfair question, because you've emphasized the risk-based nature of the way you look at digital IDs. But do you, in principle, see them as a lower risk approach than the alternatives? And whether you do or don't, what's the reasoning behind your perspective of digital IDs in terms of risk?
I think they can be, but they aren't always. The challenge is the risks aren't just higher or lower, but they're a different shape in several dimensions. So in the past, non-face-to-face KYC, know your customer checks, and digital ID were always considered higher risks, and that's hardwired into a lot of countries' regulations because as of 10, 15 years ago, that was true. The technologies and systems weren't as advanced as they are today. And that's why the guidance made it very clear that non-face-to-face customer identification and transactions with a reliable digital ID can present a normal level of risk and could even be considered lower risk. It's not always the case, but they can be. The reason for that is traditional ID isn't risk-free itself. Passports can be faked. There's still a trade in false documentation. And a lot of the risks that people worry about very visibly around digital ID exist for traditional paper IDs as well. So it's not that either of them is completely without risk. The thing that's really difficult with digital ID is that if those risks manifest, they can be exploited at much greater scale.
Another development which might accelerate the adoption of digital IDs is the pandemic that we're all currently enduring. This has clearly accelerated the digitization of all sorts of transactional activities in all sorts of businesses. Is it your sense that it's giving a little bit of a boost to digital ID adoption as well?
Yes, I think so. I mean, this has become almost the new normal. Non-face-to-face business is now standard, and digital IDs, where they exist, are a better way of doing non-face-to-face business than the alternatives of using mobile phones to verify people's facial features and check identities. From our point of view, we were working on digital identity guidance for, I think, 2 years or more. And it's pure, bad luck for the world, but good luck for us that our guidance was ready just as it was most needed when the pandemic struck. And what we've seen is an immediate surge of interest in that digital ID guidance because people are looking to it to help support confinement and social distancing measures and enable normal business to carry on during the pandemic. It's difficult to put in place national digital ID schemes overnight, so we haven't seen those suddenly springing up, but we've seen much more interest in performing aspects of customer due diligence remotely, particularly video identification. And the guidance gives a framework for putting in place mitigation measures to address potential risks around that. We don't have statistics on how many people are using digital ID, but we have seen lots of cases where supervisors have updated their advice on whether it can be accepted and in which circumstances based on the pandemic situation. And they now encourage the use of digital ID much more. What remains to be seen is how this evolves as the pandemic subsides. I'm hoping this is an area where we can build back better. These are now things that are accepted as normal. And even once we can stop wearing masks, I think we're never going to go back to seeing digital ID as a higher risk situation.
Now, a different topic. You mentioned right at the outset the use of artificial intelligence, AI, and machine learning tools, in effect, to meet regulatory obligations, what has become known, I suppose, as RegTech. How confident is FATF that these tools can actually keep firms compliant as opposed to cut their costs?
I think that's a choice. We're fairly confident that they can. We're hoping that they will. They're definitely allowing for more accurate, more immediate, and more targeted results from banks and other businesses' own internal programs. They're allowing a better use of resources, and they allow, in particular, they allow companies to focus on risk-based implementation of the standards. So what we're seeing from the companies that have been early adopters of this is that they're using their highly trained investigative staff for much more value-added work on the high-risk cases, which they can look at more deeply, because they've used technology to reduce the rate of false positives and to weed out some of the false red flags that would otherwise occupy their time unnecessarily. So in a lot of cases, this is enabling them to do a better job and identify types of suspicious activity or networks that would otherwise have gone undetected. One thing that we're hearing very strongly is that the use of technology isn't going to be able to replace human input and judgment as part of the process. It's going to optimize and increase its accuracy and effectiveness, but that's by enabling the human element to focus on the real thinking rather than on the sort of bulk processing of red flags. One of the things we're currently doing is we're working on quite a wide scoped project, and we're collecting private sector views on this issue. What types of technology are firms starting to use? And in particular, what are the challenges and obstacles and the preconditions that they've found when rolling out those technologies to enable them to work effectively? That's going to be an input to our work to hopefully address some of the barriers that exist at global level in the regulations, and also to advise countries how they can encourage this more effectively. Mm-hmm. One of the things I'm expecting to come out of this, and it's my own observation from doing country evaluations, is supervisors and firms need to move at the same speed. There's no scope for an AI RegTech system to take over some of the work of human investigators unless it's accepted by the supervisors, unless they can look inside, verify how it works, and understand it. So one of the things that we need to do more on probably is for supervisors to build their capacity to understand and oversee new technologies. There are some that are very, very good at this, the UK and Singapore, for example, but there are others which are still working on that area and maybe have a little further to go.
Now, supervisors, regulators working with these new technologies and being able to judge whether a firm is compliant, whether the firm itself is discovering new risks as a result of using this technology or managing old risks better. What about regulators themselves actually adopting AI and machine learning technologies and using them in market surveillance, checking, as we just mentioned a minute ago, compliance with regulatory reporting, and maybe even monitoring markets for financial stability purposes? It's a new term I've come across in the recent weeks called SupTech, supervisory tech. To what extent is SupTech a piece of journalistic license? To what extent is it a reality among supervisors that you talk to?
It's very much a reality, but it's one that not many of them have rolled out in their day-to-day operations yet. I think it's for a long time been part of the arsenal of securities supervisors, particularly because identifying market manipulation has always demanded those sophisticated analytic tools. What we're seeing now is the use of SupTech, particularly by supervisors which have got to cover large and diverse sectors, to enable them to focus their attention on the highest risk companies. So there are a couple of supervisors globally that are doing dynamic risk profiling. They're using, for example, payment information and a live feed of suspicious transaction reports to identify which entities that they supervise pose the greatest risk, and actually as leading indicators when something's gone wrong, so that they can move in quickly with an inspection or with whatever corrective action is needed. Now, it's only a very few supervisors that are doing that at a sophisticated operational level, but a lot more are interested in that technology because it can enable them to focus much more on the highest risk entities that they cover. That's another side of the work that we're doing on the opportunities and challenges of new technology, and we're hoping to put out some more guidance to supervisors globally on how they can start making use of these tools more effectively.
Mm-hmm. On this topic, in the wake of the great financial crisis, we saw a lot of obligations laid upon banks and investment banks and asset managers to share data about their investment and lending activities, which went into data warehouses and so on. We're talking here about both regulated firms and indeed regulators starting to pool data, share data amongst themselves, and indeed pool data about individual market participants. Are you running into legal as well as technical obstacles to actually doing that? Is that a constraint on SupTech and RegTech working properly?
I think absolutely there are legal and technical issues. I wouldn't call them a constraint. I think it's that we've got, as policymakers, to balance 5 or 6 different objectives. And sometimes those are incompatible or they rub up against each other with too much friction. So we've got to respect data protection rules. We've got to respect privacy rights. We've got to ensure data security. And all of those are fundamentally important. And if we decide that anti-money laundering overrides those, we'll very quickly find ourselves compromising a whole lot of other systems and creating new vulnerabilities. So finding a route that's compatible with all of those objectives is very important. And then we've also just got a series of technical issues. A lot of legacy IT infrastructure, particularly in financial institutions, which have had a history of upgrade after upgrade after upgrade and have gateways and so on. Making all of the rules and approaches work with legacy architecture and systems is also just a huge operational challenge, and it's one that's replicated in public authorities as well. Law enforcement agencies and FIUs have to deal with exactly the same problems when they're sharing data internally. Mm-hmm. So it's not easy. And what we're looking at is currently how some of the technologies that are emerging can actually help with some of those obstacles. Mm-hmm. With things like privacy enhancing technologies and forms of encryption can make it easier to share and compare data without exposing it to the risk of either security breaches or of infringing privacy. So those are potentially ways to use technology to overcome problems that we've had for some time.
And are you seeing a similar spectrum in terms of regulators' readiness to deal with this data challenge? You mentioned Singapore, for example, as being up to speed when it comes to taking delivery of RegTech reports. You have the same phenomenon in the data pooling, data sharing, data management area as well, I assume.
Yes, it's one of the things that we're looking at is risk-based supervision. A lot of supervisors are still moving slowly from a rules-based approach to a risk-based approach. And one of the things that needs more emphasis when they do is what they do to monitor the activity of the people who they're not actively inspecting. They have a challenge of a very large regulated population and limited resources to look at them with, and working out what data to gather, gathering it with the right frequency and using tools like that to monitor it seems to be one of the real potential ways that supervisors can be much more targeted in their approach.
Now, whenever we talk to regulated firms, whether in asset management or banking or investment banking or insurance, we say, why are your costs going up? They will say, well, our compliance bill is going up, having to hire more people, invest more in technology. Are you hopeful as you look forward that actually both regulated firms and regulators themselves, supervisors, are going to start getting better results from the investments they're making because of the digitization of AML, CFT, and other regulatory processes?
I think so. We've all, for the last few months, been looking at graphs of COVID infections and seeing new interventions and new policies and restrictions by governments. And what you see is always there's a new restriction or a new mask mandate, and months later or weeks later, the infection rate comes down. We're in exactly the same situation. The new technologies are being put on stream, they're being implemented, but all of them take some time before you start to see a real impact in terms of both costs and results. Part of that's just technical. New tools need to be trained, the bugs need to be worked out. A machine learning system needs to learn what to recognize based on good data and feedback. But the other part is that supervisors want to see that a new system is working effectively before they allow the old one to be switched off. So the initial period is you as a financial institution have bought a new system, you've put more resources into buying it and setting it up. You're running two systems in parallel for a while, so the costs go up before they come down, and they only come down if you can bring the supervisors with you and give them the assurance and the understanding that they need, that you can reduce your spending on legacy systems. That said, it's starting to happen, and we're optimistic that it is going to bring both benefits in terms of effectiveness and reductions in costs.
Transition is, I fear, a process without end. Just one final question. As you look ahead, I don't know, say relatively short term, 12, 18 months, what are the priorities that you would like to see regulated firms focusing their attention on?
It's a good question. I think there's a lot that they can do on bringing supervisors with them and collectively raising the awareness of new technologies, so that there's I think a meaningful supervisory dialogue with firms that's going to enable them to transition onto new platforms. The other thing that I'd highlight is simply based on the very recent results of the FATF plenary. You said at the beginning that the FATF standards are always changing, and we changed them a couple of months ago to include a new obligation to assess the risks of proliferation financing. So in terms of what firms need to focus on right now, they have some time to get ready to implement this, but that's going to start coming down through national regulations, that firms need to understand the risks of people evading sanctions on Iran and North Korea and take appropriate mitigating action.
Tom Neylan, thank you very much.
Thank you.